Hello and good afternoon, everyone. I'm Abhijit and welcome to a new episode of Investing Fool, where we discuss about DIY momentum investing. Usually, when we do these videos over the weekend, then we tend to focus on non-portfolio related topics. In today's video, we'll talk about the post-tax returns that we have added on our core portfolio. We'll also talk about some of the global factors and what could be the changes in the portfolio in the next rebalancing cycle. So watch the video till the very end, and if you haven't subscribed to this channel, then please subscribe. We'll also take a look at some rough calculations on post-tax returns for mutual funds versus DIY investors. So yeah, let's just get started. Before we start, the familiar disclaimer that none of this is financial advice, so please consult your financial advisor before making any investments. Whatever securities, indexes, whatever we show on this video, that is just for education and illustration purposes only. Okay, so let's get started. So taxes are a major pain point, or a major aspect of how we compute our returns, how we see the actual real world returns, right? So till now we have shown like pre-tax returns in our core portfolio, and I had said in one of the previous videos also that it has been some time this was pending, and I had to incorporate the post-tax returns also. So now we have incorporated the post-tax and the STT, which is securities transaction tax returns on our core portfolio sheet. And so let's just take a look at the portfolio sheet, and we are not talking about the individual stocks here. What we will focus here is on this, right? So we have a pre-tax absolute returns of around 40%. This was 41% a while ago, but the portfolio has corrected a bit. And while we are talking about absolute returns, when after the portfolio completes 1 year, which would be in November of this year, we would be adding the CAGR as well. It doesn't make sense now, and we won't be adding the XIRR because we are not having any new inflows from this fund or any new outflows from this portfolio. We started with a notional value of 20 lakhs. And we have just been redeploying that same capital and growing this portfolio, right? So, but if we look at the pre-tax returns and we compare that with the pre-tax returns of our benchmark index, which is a Nifty 500, then we are at 40% versus 33.4%. So there is like a 6.6% of alpha that we are having over our benchmark index. But when we look at the post-tax returns, and let me quickly discuss how we came to the post-tax returns. So whatever stocks, whatever transactions we are making, right, either they are in this portfolio or they are on the exit sheet, right? So either they are still on this portfolio, or they have exited, and that's why they are in this sheet. So to calculate STCG, simply you take the total gain or loss of all exited stocks, and we will also assume that to know the actual impact, I would have to calculate what tax or STT, anything that I would have to pay when I'm liquidating this entire portfolio today. Like if I have to liquidate this entire thing today, then how much I would have to pay in total. So you have to take the STCG from the exits, as well as you have to take the STCG impact from the stock. So if I have to sell all of these stocks today, then I would have to pay STCG on all of these, right? And we are assuming here that we will be paying STCG on 100% of the stocks in our portfolio, which is currently true. No stock has remained for more than 1 year in the portfolio. Actually, the portfolio even hasn't been 1 year old, right? So, that's a fair assumption because it's a high churn portfolio, right? So most of the stocks will be paying STCG and not LTCG. While if we have a Nifty 500 index fund, right, we will be paying LTCG for that, right? So anyway, when we compute the total tax from the existing stocks, we combine the STCG, the potential STCG impact of the existing stocks, as well as the STCG that we would anyway have to pay on the stocks that have already exited the portfolio, then we'll arrive at the total tax number. I've done some like rough calculations here, and for okay, this should not be STCG, this should be STT. which is securities transaction tax, 0.1% of whatever amount we buy or sell. So for equity delivery, we have to pay as STT. So that impact also we will need to calculate for the exit stocks as well as for all these stocks. We mix both, we add them, both of them together, and we incorporate them in terms of our net portfolio value. So if when we calculate the post tax and STT returns, then we come to around 32%. So you can see the massive dent that it has created, right? From 40% you are down to 32%. So you have lost 8% because of all this. And there are like brokerages we can assume to be zero, because many of us use discount brokers. And there are other charges also, stamp duty and all also, but then we have not incorporated dividends also. So dividend should more compensate adequately for those minuscule charges also. They are not as pronounced as STT or STCG. Okay, so when we look at the dent that has gotten created because of these taxes and transaction costs, we are at 8%, right? So from 40% we have dropped to 32%. When we look at the Nifty 500, so if you are invested in a Nifty 500 index fund, right, and you have to liquidate it today, so assume that you have already done 1 year in that, right? So you have to pay LTCG, not STCG. So LTCG is at 12.5% now. It was at 10% prior to this budget. So the dent because of that will be less pronounced, because obviously the tax rate is also lower. And even in this case, right, the dent of 8%, it looks big, but it's also a factor of where the returns are. So if the return would be at like 10%, so everything is relative, so that difference would not be 8%. It would be a little less pronounced. So here the markets have been generous this year and we have gotten good pre-tax returns. So that's why the difference in terms of pre-tax and post-tax, that also appears much bigger, right? So but anyway, if we compare these two, then we have come from 40% to 32%. And for someone investing in a Nifty 500 index fund, pre-tax versus post-tax, they are coming down from 33.4 to 29.2. So there is almost a 4% difference there. Now if we compare our post-tax and transaction cost performance with a Nifty 500 index fund post-tax, so we are still around 2 to 3%. We are around we're around 2.5% higher than the index fund. This can obviously change anytime, but this makes you understand as to how much you need to actually outperform in order to beat the index also, right, in post-tax terms. And I've done a simple calculation on this. So let's just take a look at this sheet. So here we are assuming that we are starting with an amount of 100. Okay, 100 is a notional amount. We have started in a mutual fund, momentum mutual fund, ETF, or whatever, and we grow that money year on year for 10 years. Now, because we are not taking out, we are not withdrawing anything, we do not have to pay any tax for the first 9 years. At the end of 10 years, whatever total gain we have made over the 10 years, we will pay LTCG on that. Compare that with a DIY momentum portfolio in which whatever exits we made, all of those are 100% STCG. We have to pay like STCG on 100% of the exits we make. Now we grow this also, we invest 100 rupees in this also, we grow this every year, but every year we have to pay tax on the gains, and the capital that is available for the next year is reduced by that much amount, right? So at the end we arrive with a like value for both of these. So this is like the post-tax net value that you get out of both of these approaches. Now here we have so as I said, the mutual fund taxation will be 12.5% LTCG. For DIY the taxation is 20%. So there is a 7% gap there itself, right? Now when we come to the pre-tax CAGR, so this is what we are using to compute the value of the portfolio, right? So we have two metrics here. So we are assuming that the DIY CAGR is a bit more than the MF CAGR. Otherwise, there is no point of doing the DIY. So let's say the MF mutual fund CAGR or ETF CAGR is at 20%, right? And your alpha is 2.5%. So you are then at 22.5%. So you're growing at 22.5% pre-tax, while the mutual fund is growing at 20% pre-tax, and you arrive at these amounts at the end of 10 years, right? So mutual fund is performing better than your DIY method, right? And if you look at the what is the resultant post-tax CAGR, so mutual fund has actually outscored you, and that's why like they have come at a higher value at the end of the 10 years. Now if you increase this to, let's say, from 2.5%, I increase it to 3.5%, okay? So now my DIY CAGR becomes 23.5%, and now you can see that the value net of tax at the end of 10 years is actually higher here compared to the mutual fund. So this is actually relative on the mutual fund returns, right? So if the mutual fund returns is 20%, right, then you would at least have to, in pre-tax terms, you'd have to outperform them by 3.5% at least to get to the similar level of returns. But if this assumption of 20%, why I've taken 20% here is because many of the strategies, many of the like, okay, not maybe not Nifty 500, but many of the momentum indices also, they give 20% or higher, at least the backtest shows that. So that is their CAGR since inception. So this is an assumption. Again, if we take 15%, let's say we take 15% here, okay, then with 15% you do not need probably 3.5% of outperformance to be close to their final value, right? So let's say we make this 3%. Sorry. So we are still ahead of this, right? If we make this 2.5%, sorry, if we make this 2.5%, we are still ahead of this, right? We are still close to this. So if the returns of mutual fund, the returns that you're assuming for mutual funds, if that is low, then the alpha required would also be relatively lower. But if your mutual fund is returning like 40%, okay, then how much do you have to outperform to reach that same amount, right? So you can see, okay, let's make it 7.5 maybe. Okay, so even with 7.5% alpha, if the mutual fund is like returning 40%, even with 7.5% alpha, it is difficult to beat it, right? You are still coming out lower. So you would have to probably outperform by, outperform by almost 8%. So the alpha has to be around 8% for your net value at the end of 10 years post tax to be close to the mutual fund returns. So whenever the returns of the mutual funds are high, so in this like this year also we see that Nifty 500 itself has given in the same time period a return of around 33%. So the alpha needs to be much bigger, right? So that's why even with a high alpha, after tax we are reasonably close to the to the mutual fund returns, right? When the returns are lower, like the mutual fund returns are lower, then the alpha required would be relatively lower, okay? So if you need, just let me know. I'll share this link. It's anyway just a rough calculation, so you can play around with the values anyway. Okay, so let's go back to the slide. So considering the post-tax returns, you will need, as I said, an alpha over your benchmark index to actually outperform, and all this depends on how much your mutual fund is earning pre-tax, how much you want, like how much you expect your alpha to be, right? And then there are tax changes on top of it, right? Government can come and say on any budget day that we are increasing the tax further. Mutual funds enjoy the benefits of deferred taxation, so that is always there. If you look at the transaction costs, right, so to reduce the churn and to reduce the transaction costs because of churn, you have various methods available. You can loosen your exit criteria, probably like if you have a worst rank held of 50, you can loosen it to maybe 75, and or you can increase your rebalance period also. If you're feeling that if you're doing a weekly rebalancing, so many stocks are going in and out, you can change it to monthly. If you're doing like monthly, then probably you can look at something like 3 months also. But yeah, so that all is possible, but all of those things come with their own effects, right? So they have they will hit your responsiveness, the responsiveness of your portfolio. If you have like a 3 months rebalancing and some stocks start falling like left, right, and center, you do not have the possibility of churning them out of the portfolio, right? So all those things are there. There are multiple benefits that DIY investors enjoy over mutual funds. And now when we are talking about mutual funds, we can also talk about momentum mutual funds, right? Because when we are because if you are considering an alternative to DIY momentum investing, then momentum mutual funds is something that you would look at, not probably the Nifty 500 fund. And here I will at the very outright state that our like portfolio has not beaten even the Nifty 200 momentum 30 ETF or mutual fund. So whatever is true, we have to spell out, right? We started this channel saying that this like we are doing this sort of we will like experimentally follow this portfolio. I have invested my own money in this portfolio, but we will report everything as it is, right? So we are underperforming almost all the NSE created mutual funds and ETFs, but it has been less than a year. So anyway, you cannot say that like things would be the same even with 3 or 5 year horizon. We'll have to be there, we'll have to track it for that long to know, because the market has been in a kind of secular uptrend, right? So the market has not seen any reasonable level of correction. They're just going up, and any small dip that gets created gets bought into, right? So that is also another caveat. So there has not been any need for a major rebalancing. The primary con that I see with most of these indices is that they rebalance at a very long period, right? So some are doing at 6 months, some are doing at 3 months, right? But still, like so that is one of the primary con that they have, but still they are beating our returns, right? So whether that continues when the market sees a downturn or a sideways turn, whether that continues, that outperformance continues or not, that we will have to see. But even a chunk of my personal portfolio is also in these ETFs, in these momentum ETFs. So recently Motilal Oswal launched this Nifty 500 momentum 50 index fund, and there are many like ETFs and index funds for other NSE created passive momentum indices from before also. And there are multi-factor indices also that NSE is trying to create and bring in to the market. Here we are only talking about mostly momentum based indices. So the other con is that if you want to play in a universe bigger than Nifty 500, right? So currently we are doing this portfolio construction on the Nifty 500 universe. If you want to go beyond that, the top 1000 stocks or maybe all stocks of NSE, then you do not have any options in momentum funds or ETFs. So then you would have to go to DIY only. Now, momentum index funds and ETFs definitely have multiple advantages of their own. Deferred taxation, as I said, so they are tax efficient. You do not have to do any effort yourself. You just invest. If you want to invest by a SIP or lump sum, whatever, you just do that, and you keep enjoying those benefits for you can basically keep investing for decades and then pull out the money at the end and pay tax at that point of time. And these have shown decent CAGRs even with significantly longer RB periods, rebalancing periods. So this is just a rough sheet that I had created. So we had created a different video on ETFs and mutual funds long ago, and This is just a very simplistic comparison based on whatever data NSE has given on their fact sheet. So you can go to the Nifty indices website anytime to check this out. But if we look at the CAGR, right, most of these have like a CAGR of more than like 21%, and many of these have a beta of less than 1, right? So they are pretty favorable in that respect, even if the RB period is like at least 3 months. So they do not have any monthly rebalancing. So in that sense, when the market is in a longish bull run, these indexes tend to perform really well. Okay. Anyway, let's move on to something else. Okay. We will talk about the portfolio also a little bit, and we'll talk about some global factors. So before that, let me just see. Okay, so the final point here is that it depends on your personal preference, right? If you want to invest in universe larger than 500, and we have also talked about this previously. If you want me to like create like a different portfolio comprised of like all stocks of NSE maybe, then please comment below the video, and we can probably do that. The only thing is that there would have to increase the number of stocks. So it would be probably upwards of 45, maybe 50, and then the monthly churn, the number of stocks that would need to be sold will be much higher, right? So there also we can have like a monthly rebalancing, but we can do that. So let us know in the comments below. But yeah, so final points: if you want to invest in a universe larger than 500, or if you want to enjoy the benefits of shorter rebalancing, which is not apparent in this year but maybe in some other kind of market cycles, then you can go to DIY momentum investing. But you have to ensure that you are not performing at the same level at the mutual fund or index fund. So you have to like have some alpha over them in order to rationally justify. um, so I will be anyway following this portfolio for multiple years before I take a call, even with multiple market cycles. If we are sorry, not able to come anywhere close to the established indices that NSE has created, then it doesn't make any sense as a financial person to continue DIY investing, right? We can look at some creating a new portfolio based on a wider universe also. So if you want shorter rebalancing, if you want a wider universe, right, if you want some other filters that you think could have an alpha, and then please go to DIY. If you want less hassle, you want to be very tax efficient, and these mutual funds are very tax efficient when the tax regime is higher, which is currently the case, and it might even go higher in the next few years. Then you can just stick with momentum ETFs or index funds, and NSE will bring out a lot more of those in the coming years as well. More and more of these are getting created. Anyway, so those are the final thoughts on this. Let's move on to some global factors that we need to discuss. So crude has continued to slide. Actually, it's gotten like almost till 70 per barrel. And there is like the issue of global demand is always there, and it has hit the lowest price since June of last year. OPEC Plus has so there were plans to boost production by OPEC Plus countries, and they have sort of put that in the back burner. They are delaying it because there is low demand, as you can see, and stocks will react as per the industry. So on the right hand side, you see the stock of one of our portfolio stocks. This is the chart of one of our portfolio stocks, which is Oil India. And as crude prices have slid, the stock price has been hammered, right? So we bought it somewhere around here, maybe after this uptick, and it continued to slide. After that, we were in negative. Then it regained this momentum. It kind of extended its rally in the same channel, right? And we continued going upward. And now with all this news of crude going downward and the outlook probably not looking as bright, it has shed all of those gains, and it has come down very hard and very quickly, right? So we are almost where we started with. I'm not sure if we are overall even in gain or loss. So yeah, we are marginally in gain, 1.3% gain. Doesn't make any difference. But yeah, so your stocks will react as per the industry they're in, right? So oil India will react negatively, of course, when crude is going down. But stocks like paint stocks or maybe tire stocks, for which petroleum is used as a raw material, right? They will benefit from the falling crude prices. So all the paint stocks will probably, in price terms, they should be expected to do well if crude continues to slide. But let's see where the crude like price trend goes. We had the weaker than expected US jobs data. This is non-farm payrolls data. Unemployment was in line with estimates, but this has again triggered those familiar fears of US going into recession again, or whatever. We saw a massive sell-off in Nasdaq and Dow Jones, and we market is like, some participants, almost like 25% of the market is anticipating a 50% rate cut in mid of September 18. We should be knowing what has happened with the US Fed rate cut, and there are some murmurs in the Indian market also that even if US Fed cuts the rate, RBI is not going to follow suit at least this year, and we might start with a rate cut cycle in the next year, considering our there are no such fears in terms of unemployment or even in terms of growth in the Indian economy versus the US economy. Of course, the nature of our data that we get in our economy is also not as strong as the US, but 75% of the market still kind of estimates a 25 bips rate cut, while the others, the other 25 to 27%, they kind of assume a 50 bips rate cut. So sorry, this should not be 50% rate cut. This should be 50 bips. I'm not sure what I was thinking. Anyway, so when we come to gold, and I've always said that gold is an excellent hedge when it comes to balancing your equity curve. So gold tries to be negatively correlated with equities in most circumstances. So when equities dive a lot, then gold tends to go higher. Personally, I have also allocated close more than like 15% of my personal portfolio in gold, and I'll probably increase that to 20% as well. But in the short term, while the long term outlook for gold remains strong, in the short term, because of this US jobs data and the worry about how much what is the gamut of rate cut that we could get, gold prices have cooled a bit. Now, when we talk about gold, it is necessary to understand that unlike bonds, gold doesn't give any interest, right? So when interest rates are higher, there is a higher opportunity cost in investing in remaining invested in gold, right? Because you are losing that interest which you could get on bonds. So there is a higher opportunity cost of investing in gold. When the interest rates come down, then the opportunity cost of holding gold reduces, right? So that is why typically gold tends to do well when the interest rate cuts are going on. So that is something that we can expect, and there are some estimates that at the end of this year also we could gold could end at like $2,700. So let's see where that goes, but the long-term outlook remains positive for gold, and with the kind of returns that equity markets have given, markets could consolidate for some time, or like I'm not hoping for it, but if there is a correction, then gold should be expected to do even better at that point of time. Multiple central banks, with the kind of geopolitical risks that are increasing, multiple central banks are buying gold. Russia is buying gold, China is buying gold. The pace might like go off and on at times, but this has been the general trend this year. Bitcoin has slid down to $54,000, and let's see how it with if there are like aggressive rate cuts, Bitcoin should also do well in line with Nasdaq and others, but because of we are not sure whether the high rate cuts, higher interest rates, have they impacted the economy to that level that there are like significant fears of a recession or anything like that. But yeah, with all those fears, Bitcoin has really slid down, and it was holding well above like 60K. But let's see how it goes up. Like in this week, it should be like oscillating, but after September 18, how it behaves. The general trend of defense out, pharma in the portfolio has been continuing, and we will, let's take a look at, if I had to rebalance the core portfolio today, then what stocks would go out and what stocks would come in. So these stocks would go out if I had to rebalance the portfolio today. So we had said that we used to have like 5 defense stocks, 3 of them exited, right? It is very clear that sector rotation is going on in the market. So PSUs are getting I won't say hammered, but they have definitely lost some momentum. Whether they could regain it at some later point of time, we do not know that. But out of 5 stocks, our 3 defense stocks had exited, and at that point of time also had said that if HAL and BEL, the performance doesn't improve a lot, then HAL and BEL would also move out of the portfolio. And if I had to rebalance today, then HAL and BEL both would be out of the portfolio. You can see the charts, the momentum has just cooled off. The way they were growing, that growth has completely gone off. They have, like in the last 3-4 months, they have not done anything basically. And the third stock that could go out is Torrent Power. Here the momentum cooling is not as pronounced, but then it's, I mean, I really don't like the kind of the chart that I see over here. Tends to make a lot of volatile movements, but anyway, this is another stock that could go out. All of these could go out because of their ranking. Their ranking has fallen below 50 on the screener. So if these 3 go out, what 3 can come in, right? So as you can see, all of these are either defense PSUs or capex heavy cap goods power type stocks. If we look at the inclusions, so the inclusions are Suven Pharma, Eris Life Sciences, and Piramal Pharma. None of these stock are recommendations. We have like clearly wrote that down at the bottom, so please consider that just for illustration purpose. But you can see their charts. All of these stocks are just going strong, going strong, and all 3 are from pharma, right? So the general trend of defense and PSUs out and pharma in has been continuing in our portfolio. If this were to actually become true at the at the next rebalancing, then we would have like 7 pharma stocks. We already have like Torrent Pharma, we already have Lupin, we have Granules, we have Glenmark. So we have 4 pharma stocks already in the portfolio, and if 3 other pharma stocks get added, then almost 7, right? So almost 1/3 of the portfolio would be in pharma. And while in momentum we are market cap agnostic, we are sector agnostic, this is a reality that you have to grapple with, that sometimes your momentum portfolio will overly saturate itself in one or the other sectors, which are either running or the market is expecting them to run, because of which prices have gone higher. So because many people have been signaling that at a broader level the momentum is sort of cooling off and we might consolidate here for some time. So there is a tendency for investors to move their money into defensive sectors like IT and pharma, and that is what we are seeing in the portfolio. As more and more pharma stocks get investments, get liquidity, their prices run up higher, their momentum scores improve, and as their momentum scores improve, they keep coming to the portfolio. So it is very much likely that in the next rebalancing cycle, which is on 15th, we may get some more pharma names as well, but we'll see when it comes. So that's pretty much it for today, guys. Let me know if you like the content, if you have any questions, or if you feel there are some issues with anything that we have discussed so far. Please let me know in the comments below. Thanks for watching this video, and I'll see you in the next video. Till then, have a happy rest of the weekend. Take care. Bye bye.